Hi, I'm Sakine, the owner of Tax Formations, which is a tax consulting business that specializes in tax structuring and tax advice. Today's video is about the difference between an LLC and an S corp, and when you might want to make the decision to switch from an LLC to an S corp. So there's a lot of hype and there's a lot of confusion, and it's actually not that complicated. The difference between an LLC and an S corp from a tax perspective is that when you own an LLC, all items of income and loss flow through to you and are reported on your personal income tax return if you're the sole owner. And and you have to pay self-employment tax on 100% of that income. Whereas if you own an S corp and you're the sole owner, um, all items of income and loss again flow through to you, and you have to pay tax on it. But you only have to pay self-employment tax on the portion of income that is distributed to you as a salary. So you want your salary to be as low as possible. And the IRS knows this, so they have a reasonable salary requirement. So your salary has to be reasonable, but keep it on the low side to save more money on self-employment tax. So this can actually be a huge tax saving opportunity because imagine self-employment tax is 15.3%. So on 100% of your income, you're reducing the tax rate by almost 15.3%. So it's a pretty good deal. Now, there's one other huge big difference between an S corp and an LLC, and that's not with respect to tax savings, but tax filing responsibilities. The thing with an S corp is you have to file quarterly estimated tax payments each year, and you also have to file a separate Form 1120-S each year for the S corp. Whereas with the LLC, you don't have these quarterly filing responsibilities, and you don't even have to file a return if you're the sole owner. As you know, it's a disregarded entity, and it's just reported on your Schedule C. So, from a tax compliance perspective, an S corp is more burdensome, but not substantially so, but it is more burdensome, which is why I recommend that when clients reach a certain income threshold, they switch to an S corp. When they reach a certain income threshold, the tax savings from S corp status is more beneficial than the burden of additional tax compliance. In my opinion, that income threshold is 40,000, which is pretty low. Um, so basically, if you're making more than 40,000 in income, and you're the sole owner of an LLC, you might want to consider transitioning to an S corporation. So that's basically all there is to it. That's the big difference. And there's a lot of confusion. A lot of taxpayers think there's more to it than that, but there really isn't. There is one final thing that I could note, which is that S corps have restrictions that LLCs do not have. But if you have a smaller business, the S corp restrictions really wouldn't apply to you. So if you found this video helpful and you'd like to discuss further, or you have any comments or questions, you can reach out to me anytime. My website is in the description box below, as well as my email address and my phone number. Thanks so much.